Our first segment and our first guest of the show today. Let me welcome on board Mr. Suresh Sadagopan. He's the founder for Ladder7 Financial Advisories. Mr. Sadagopan, thank you so much for joining us today on ET Now. So to start with, there are two new things that have happened, in the last 2 days. One is we received our incomes and our salaries, and why it's new is because we are getting it at a time when we actually do have the avenues to finally go around spending that income. I must say we must consider ourselves lucky that we still have that flow of income and salary coming in. Those viewers, that still have that must consider themselves as lucky, because of course we are in dire straits in terms of economic activity, in terms of the job status as well. Now you have avenues to spend it, Mr. Sadagopan, finally after 2 months once again of being in a lockdown. So it's very tempting to get into that spending binge. How do you avoid that?
Yeah, so we will have to get to the basics as far as savings and investments and goals and those kind of things. So normally, for a young person, there are a lot of avenues for them to consider spending on, and especially like you rightly pointed out, in these COVID times, when there is a possibility of you to go out and spend, and you still have an income there, that's a very alluring possibility. But at the same time, see, there is no problem about spending your money. You have to have a kind of a budget for your needs, your wants, whatever you want to spend on, your short-term goals, your long-term goals. So you need to save for all those things. So very, very broad estimate of what one can spend and what one can save is in the Indian context, it is about 30% if one is going to save and invest on a monthly basis. Then I would very broadly say that they could probably spend guilt-free. Also contingent upon what kind of an income we are talking about. If it is a 1 lakh, it can be different. If it is 5 lakh, it can be different. So the kind of wants and needs can very much be different depending on the salary level, depending on the age of the person also. So very broadly, to summarize, I would say if you're putting aside something like 30% of your income, broadly speaking, that should be fine. If you're able to do more than that, fantastic. If you're doing less than that, I would advise a bit of caution.
Very rightly said. Of course, budgeting is a very personal choice. It's very subjective. You can't paint it with one brush. Somebody who's earning 20 lakh rupees or 30 lakh rupees per annum, their budget would be very different from somebody who's earning 7 lakhs and 10 lakhs per annum. In fact, what you would classify as, essential expenses and aspirational or luxurious as well would be very different. A luxury for someone, an essential for someone might be a luxury for some. So it's a very subjective thing, and I think you have to look at your own income levels as well, and then decide that what's the what your lifestyle should be like, or how can you sort of fit your lifestyle within the financial realities as well. So it's extremely important to do that. But ordinarily, Mr. Sadagopan, here's where a lot of individuals get confused as well. Should should it be that your saving figure should be the same, or should it be higher if your levels of income are a bit lower? Because we often say that income minus expenses shouldn't be savings. It should be income minus savings that should be expenses. So if the saving percentage is same, regardless of what your income levels are, then automatically the expenses as well would adjust itself. So is it that the saving percentage should be standard regardless of how rich or how low your income level is?
No, saving percentage is going to be different for different people. It is going to be a factor of what kind of goals you have in the future, what kind of dependencies are there in the family, and what is the income quantum that you're earning. Suppose a person is earning a very high level of income, let us say maybe 3 lakhs or 4 lakhs per month. So for this kind of a person, the expenses, even if it is somewhat higher, it is going to be maybe 30-35% of their income, or maybe even 40% of their income. So they have the potential to save the rest of it for their goals and other long-term goals. Whereas if a person is earning, let us say 80,000 or 70,000, it is still a decent income. But if their expenses are going to take up, say, 75 or 80% of that of the income that they are earning, they have a potential to save only the rest of it. So it can be quite different based on the income levels. and based on the aspiration level. So there are people who are earning comparatively modest incomes, but their wants are very, very aspirational. So on that front, some of the people tend to save much less as compared to other people at even the same income levels who are saving. Again, I will only go back to the ballpark estimate which I gave you. If a person is approximately saving something like 30%, then they are doing fine. For high income earners, they have the potential to save much. And for comparatively lower income earners, it can be, especially at the early stages in life when there are lots of aspirations, the potential can be comparatively less. It can be, say, maybe 10 of the career to save a slightly lower amount. I do understand there is an impact on compounding, but it can catch up when the income catches up. So I would, with that caveat, I would say for young people, they can probably save maybe 20% or slightly less than that. I'm okay with that, but they have to bump it up as the income level goes up, as their salaries move up over a period of time.
So let's talk about now deploying that savings. Actually, before that, let me once again ask you a question on the quantum of savings. We are living in extraordinary times. Like I mentioned, we have experts warning us of a third wave looming around the corner. Unfortunately, the government has had to deploy special task forces as well to states like Kerala, Odisha, Chhattisgarh, like I read in my headline. So we still have some uncertainty looming ahead of us. Is this when we sort of look at perhaps amping up our savings a little more considerably than we would have otherwise because of these uncertainties looming ahead of us, because we are still facing the threat?
Mubina, here, if you look at your own expenses, I look at my own expenses, I think we are all spending much less than what we were used to spending once upon a time. I mean, revenues for spending has gone down, so spend on entertainment and various other things, and the avenues have also dried down. So what for most of us, we are getting the same level of income. So the potential for savings has dramatically, considering the uncertain times in which we are, the third wave, fourth wave, what we are hearing. It is good to build a contingency fund at least at this point in time. For those of them who have still not built a contingency fund and were actually having a problem in wave 1 and wave 2, at least now they can start building a contingency fund. Enough liquidity in the bank, have enough liquidity maybe over and above, maybe in a liquid fund or say ultra short-term fund kind of a fund. So that, any uncertainties which may come upon us in the future months can be easily tided over.
All right. Now let's talk about deployment of those savings. Mr. Sadagopan, where would you recommend? We know that we have to save up money, buffer up our contingency fund. The question is now avenues of investments. Where should we be putting all that money? Because obviously putting it in a savings account is as good as yielding nothing on it, maybe just a meager 2 to 3%. So the question now comes to investments. Where should we invest all these savings?
The point is the return that you're getting from the arbitrage fund is going to be subject to equity taxation, which is 15%. So the amount in your pocket is somewhat higher than what you can potentially get from any other short duration debt instrument. So I would suggest an arbitrage fund for liquidity parking. So anything, any goal, any expenses, any requirement which is at least for a duration of, which is going to come up in a duration of 3 years, I would suggest these kind of investments only. Whereas if somebody is really looking at investing from the long-term point of view, that is when I say long-term point of view, 5 years and more, it is only then they can actually deploy those money in equity-oriented assets. And these are uncertain times. We don't know where the market is going. In spite of the COVID, markets worldwide have been booming. And even now we are at an all-time high at this point in time. So we really don't know what we are, where we are heading, whether this is the right time to invest. And no time is the right time to invest, or no time is the wrong time to invest. So as long as a person has the investment horizon of say well beyond 5 years, and they're really planning for their retirement or really long-term goals like children's education and future, they can invest in equity-oriented funds. My favorite these days, especially in terms of large cap oriented funds, is one can look at Nifty 50, One can look at Nifty 100 oriented index fund. One can even look at Nifty 500 fund because even that gives a very good diversification across the entire market, and that can also be a great place to deploy one's money. And beyond the passives, if one is interested, then one can look at large cap, large and mid cap, flexi cap. So, I mean, that has to be carefully put together. I mean, I cannot really say for all the viewers that this is what you can do. Probably a professional can potentially help you. But I think the place to start with will be these index funds, and you probably cannot go wrong with these index funds. That could be a good place to start.
Mr. Sadagopan, I would like to ask you about existing investors. I think you've given a good guide for new investors where they can start off, index funds and then large caps, mid caps, etc. It's a very clear choice if you are a long-term investor. In fact, you have more options as well if you're a long-term investor. What about those who already have their investments going on? They may be suffering a bit of a cash crunch. Like you mentioned, we are uncertain in terms of COVID, but markets are at record highs. Is it okay if they pause their SIPs or even perhaps consider redeeming, tapping into these, into their money which is lying in equity MFs?
Yeah, absolutely. I mean, this is very fortunately probably a good time for them to dip into equity. And if they do not have sufficient liquidity or sufficient contingency funds, it may be a good time for them to liquidate that and bring it into appropriate liquid funds or other funds from the contingency provisioning point. So yeah, I mean, absolutely. I mean, one should have appropriate liquidity, appropriate contingency. We cannot only look at investment returns all the time. I keep saying this to all my clients that it is important for us to look at the life itself and achievement of the goals and various aspirations the family has, more than the investment return. I mean, the family is not going to be greatly thrilled if one segment of your investment is giving some 21%. They are more keen on ensuring that whatever goals have been planned for and the family is looking forward to in terms of achieving, it is very, very important for the family to achieve that wherever you happen to invest that money. So that is what we will have to focus on. Contingency and liquidity is very, very important. Yeah, if it is needed, bring the money out from equity and put it in these appropriate buckets. The family should not suffer.
Let's talk about that then, Mr. Sadagopan, because many of us have our home loan EMIs, car loan EMIs, credit card bills as well to pay. And unfortunately, as we were in the midst of the pandemic, many people took loans as well to stave off any cash crisis that we are in the midst, they may be in the midst of. Should you consider prioritizing those bridge loan repayments over, other things? Do you think that debt payment should be on top of the list, perhaps even subsuming or, over prioritizing over investments?
Yeah, absolutely. I mean, we will have to see what kind of debt we have taken upon ourselves. So suppose it is a high cost debt that we have taken upon ourselves for tiding over a tight situation. And if the market is at such a point, I mean, where we are ahead of 52,000 of the Sensex, it's a good point. If one has investments there, it's a good point for us to cash out at a good profit and have an opportunity to retire the debt that one may have. So any high cost debt, I definitely would suggest the investors to retire high cost debt. And as far as comparatively low cost debt, there are two ways of looking at it. If the amount of debt, for example, in the case of a home, the amount of debt is very high, let us say 1 crore or maybe 80 lakhs, 70 lakhs, something like that. I mean, if it is something very high and they are not very comfortable about that level of debt, they can pare down.
We've lost that audio with Mr. Sadagopan, but yeah, we were talking about paring down debt, especially if you've taken some emergency loans in these last few months to stave off any cash crisis. Okay, we managed to get him back. Continue your point, sir.
Yeah. So I was saying that if the debt is, let us say, especially a home loan, and I mean, home loan normally is not really a high cost debt, and you have the income to take care of that on a monthly basis, then I would suggest that you continue with that. And since that is a low cost debt, focus on the investment where the potential for getting a higher return always exists. So to summarize, I would say if you have a high cost debt, look at retiring that. If the the loan amount, even in the case of a home loan, if it is very high and you're not comfortable with that, consider reducing the amount of debt and bringing it to manageable levels. Otherwise, if the amount of debt is at a manageable level and you're comfortable with that, then you could potentially use that money for deploying in any investment avenues appropriate for you.
Okay, well, there you have it, an A to Z when it comes to, ensuring that you properly utilize your salary. Don't go into a post-lockdown spending binge, which could be very tempting, especially given the fact that across the country we are slowly seeing, unlocking activity. You're allowed to travel, you're allowed to take short vacations and holidays as well across the country. But two reasons you shouldn't do that. Firstly, COVID is still a threat. There's still a threat of a third wave, and we do not want to enter that vicious cycle. And secondly, of course, money constraints too. Okay, well, it's time to take on board some questions and queries. Remember, folks, you can connect with us on our email address, themoneyshow@etnow.tv. Any questions or queries on what is prudent financial practices, write into us on that email address. We are monitoring it and we can, get it answered. Well, we have our first question coming in from Rajesh Daswani. He says, I have about 15 lakh rupees invested over the last few years to purchase a house in 2022. But in light of the current situation, I have stopped my SIPs in some funds. His aim is to preserve capital, and now he's looking for a duration of 6 to 9 months. I think it makes sense because obviously now his goal is 6-7 months away, because believe it or not, 2022 is now just 6 months away. He's asking your advice, Mr. Sadagopan, on how he can trim his portfolio and keep the risk minimum. So he's got lots of funds actually. He's got the ABSL Money Manager Fund, Tata Banking PSU Mirae Asset Large Cap, L&T Mid Cap, and then 2 ultra short-term funds from IDFC, ICICI Pru, HDFC, Nippon and Mirae Asset Savings. So I think a large amount of his SIPs are in the debt category, and he's just got 2 equity funds, L&T Mid Cap and Mirae Asset Large Cap, and by the way, those are on hold. So very interesting. He's got lots of SIPs going on in debt funds, which are still on, by the way. What is the strategy here? He's invested in equity funds, Mr. Sadagopan. Now he's approaching his goal. He's stopped his SIPs and continued in some. So what should he do? Is this the time where he should remove it from the equity portion as well and put in debt, or perhaps trim down a little from debt as well?
So let me tell what is the normal strategy we advisors, financial advisors follow. So normally when we come near an important goal, like acquiring a home is a very, very important goal. So when we come near a goal like that, maybe 2-3 years before we start liquidating, we can bring to, which we want to deploy into debt-oriented or arbitrage-oriented funds. So that is exactly what I would have suggested Rajesh. So whatever equity he has, like we saw, the equity markets are at an all-time high. So it gives him an opportunity, if he's okay with liquidating that and bringing it to probably an arbitrage fund. My fund of choice at this point will be an arbitrage fund. As far as ultra short fund is concerned, typically the volatility is low. So he has been doing all the right things by investing SIP in an arbitrage fund, so that is absolutely fine. But my suggestion going forward would be to primarily deploy the money into arbitrage fund for the next 6 to 9 months. Whatever money he has, he should deploy in arbitrage funds. Arbitrage funds, have very low risk, inherent risk, and they have the potential to give maybe 4 to 4.5% kind of returns. And the taxation here is benign, and his duration is very short term. So the taxation here is benign. So probably on a tax-adjusted basis, that will be the best investment.
Word of advice coming in on our first question, and I think it's a very relevant question that, you just can't keep holding on. As your goal comes nearer, you need to rejig your portfolio as well, because now you need the money in the next, few months. So you don't want to keep it in very volatile assets. Okay, let's take on board one more question from Vijay Chand. He has a very small portfolio, 4 funds: Axis Blue Chip, Mirae Asset Emerging Equity, Kotak Standard Multi-Cap, and Tata PE. He is asking you if you should continue with these funds. Now, interestingly, there's, what we call as a smart beta fund, or a factor fund as well. But anyway, let's assume that he is a long-term investor. He's investing, for general wealth creation and retirement. Does 4 funds cut it out? And do you think he should add more? What do you make of these 4 funds?
Yeah. So I mean, the funds which have been chosen are all good funds. I mean, there is no problem at all. There is one large cap fund, there is one large and mid cap fund.
Thank you so much for joining us today on the show. And ladies and gentlemen, to you as well, keep sending in your questions and queries. We'll get them answered over the course of the next week on The Money Show as well. For now, we'll have to take a very short break. Be right back.